massive day for the unemployed, because the riskiest moment of the entire AI bubble just arrived, and it is wearing a rocket. SpaceX, which went public in June in the largest stock listing in human history, $75 billion raised, bigger than Saudi Aramco, has since lost around $1.2 trillion in market value, falling in 13 of its last 16 trading sessions, crashing through its listing price and dragging Elon Musk from a reported net worth of roughly $1.45 trillion to under $700 billion in about 6 weeks. The world's first trillionaire reportedly posted 2 words online: former trillionaire. And underneath that spectacle sits a genuinely dangerous piece of financial machinery, SpaceX and Tesla, whose headline numbers secretly lean on each other's stock price, both falling at once, both run by one man, at the exact moment the whole AI market is wobbling. Today Meerkat shows you why this specific wobble is the riskiest moment yet. Let Meerkat explain. But first, a domestic update. Meerkat has taken up Jenga, a loan, which the shop assistant said was unusual, and which Meerkat maintains is no stranger than golf, another game where a man ruins a structure he built himself and calls it recreation. He builds the tower as tall as it will go, then removes pieces from the bottom to place on top, marveling at how something can look taller and grander while becoming structurally more insane with every move, and at how the crowd, if there were one, would cheer every extraction right up until the physics submits its invoice. Keep that tower in mind through everything that follows. It is the best financial diagram Meerkat owns. It cost $9, and unlike his last 3 hobbies, it has already paid for itself in metaphor several times over. The shop assistant also asked if the Jenga was for a child, and Meerkat said yes, because the truthful answer, it is for financial modeling, felt like more conversation than either of them wanted. He made a pot of tea you could waterproof a roof with, set the tower up on the desk as a reference model, and read everything. 3 parts. Part 1, the fall, the numbers behind the collapse. Part 2, the trick, the accounting sleight of hand that ties 2 giants together. And Part 3, the risk, why this could be the pin. Settle in. Your evening, as always, is wide open. Part 1, the fall. First, understand why the listing happened at all, because the timing is the confession. SpaceX did not need to go public. Private investors had funded it happily for 2 decades. It chose to go public in June 2026, at the exact peak of the AI mania, when markets were at records and the appetite for anything Musk-adjacent was bottomless, raising $75 billion in the largest debut in financial history. You list at the top because that is when the shares fetch the most, and the people best positioned to know where the top is are the insiders selling into it. The public was invited to the party at the precise moment the host wanted to convert the party into cash. And the listing did not just take money from the buyers, it took money from everywhere. A raise that size acts as a capital vacuum, with global funds reportedly trimming positions across entire markets, including Asia, just to free the cash to participate. The biggest debut in history was so large it visibly drained liquidity from other continents. Remember that, because when the same shares then halve, the damage is not contained to the people who bought. It ripples back through everyone who rearranged their portfolios around the event. The listing was meant to be the crowning moment of the boom, the largest debut ever. A rocket company floated at the top of the market. It peaked around $225 a share. It now trades near $113, a cheeky halving, having fallen most days it has opened, crossing below its listing price for the first time, which means anyone who bought in after the first couple of days is underwater. And notice the shape of the decline, because the shape is the diagnosis. This has not been one crash day with a scary headline and a bounce. It has been 13 red sessions out of 16, a steady, grinding, orderly exodus, which is far worse news than a panic. Panics reverse. Panics are emotional, and emotions swing back. A patient, daily, relentless walk toward the exit is not emotion, it is decision. Thousands of large holders having concluded, calmly, at leisure, that they would rather be elsewhere, and acting on it at whatever price the day offers. There is a widely shared clip of a 92-year-old woman who bought her very first share ever at that listing, thrilled, having spent ages hunting for the ticker symbol. Meerkat thinks about her often. Buying a high-growth tech stock at its historic peak is a rite of passage. Sure, everyone gets one, but it does not usually involve a 92-year-old's first-ever investment dissolving like candy floss in a puddle, while the financial press debates whether this is a healthy consolidation. She was sold the crowning moment of American capitalism. She received the top tick of the largest bubble in history, hand-delivered, with commemorative branding. In total, SpaceX has shed about $1.2 trillion, a sum almost exactly equal to the entire value of Tesla. SpaceX lost a whole Tesla in weeks. And a detail the cheerful coverage keeps skipping. Newly listed companies come with a lockup period, a window, usually about 6 months, during which insiders and early investors are barred from selling their shares. SpaceX listed in June, which means the flood of insider shares becomes legally sellable around the turn of the year, into a stock that has already halved. Every early investor is now staring at the same calendar and the same chart and doing the same maths. And the maths says the exit gets very crowded the day the gate opens. Markets are forward-looking machines. Part of what you are watching in this relentless daily selling is the market pricing in the queue that forms at that gate. Now the faithful have a defense, the one every holder reaches for in a crash. He has not really lost anything because he has not sold anything. And that is true, in the same way its cheeky mirror is true, he never really gained anything either, because he never sold at the top. Wealth measured in a stock you are legally barred from selling is not wealth, it is a rumor with a share price. And that distinction, boring as it sounds, is the whole reason this moment matters to you, a person whose portfolio is a coffee card. Because the entire AI boom is priced on rumors with share prices, paper valuations everyone treats as real money, and the moment the market remembers the difference, every inflated number in your pension gets re-examined at once. And Tesla is not helping. It reported results that were, and Meerkat will be gentle, bad. Record revenue and record deliveries, yes, those are the nice numbers. Everything else was the opposite of nice. Operating income fell by more than half. Operating margin collapsed to around 1.4%, down from over 4% a year earlier. For scale, that is thinner than a supermarket's margin, thinner than an airline's in a decent year, which is less the margin of a titan priced for galactic conquest and more the margin of a struggling bakery breaking even on sourdough during an egg shortage. Earnings missed badly, free cash flow went negative, capital spending leapt, and the once fearsome electric car lead has been ground down by cheaper Chinese rivals eating market share on every continent while American incentives dried up. The stock dropped over 13% in a single session, erasing more than $140 billion, and the faithful, for the first time in a long time, did not buy the dip with their usual religious enthusiasm. The earnings call itself offered no rescue. Musk, audibly unwell on the call, coughing through his own turnaround narrative, repeated the same promises about robots and self-driving taxis he has reportedly made every quarter for years. Promises where the word soon has become a flexible concept, residing somewhere between next quarter and the heat death of the universe. Combined, SpaceX and Tesla shed roughly $1.5 trillion in market value in a single month. And Musk's own net worth, measured almost entirely in these two falling stocks, was cut nearly in half. A loss of around $750 billion, which is close to the combined wealth of the next 3 richest people alive. He did not just lose money. He lost, in 6 weeks, 3 entire other billionaires. Part 2. The trick. Now the part that turns a bad month into a systemic risk, and it is a cheeky bit of accounting you need to understand. Tesla owns a large stake in SpaceX. Under the standard accounting rules, the honest, official, by-the-book rules, every quarter it must revalue that stake to match the current market price, and any paper gain counts as income. This is not fraud, and that is the cheeky horror of it. It is entirely legal, entirely standard, and entirely misleading, a profit that looks legitimate precisely because it followed the rules, while representing no cars sold, no cash earned, no thing made. The rules were written for companies holding modest stakes in stable businesses, not for a car maker holding a giant slab of the most volatile mega listing in history. Feed an extreme situation into a reasonable rule and you get a reasonable-looking absurdity, which is the most dangerous kind, because auditors sign it, journalists repeat it, and index funds buy it. So when SpaceX stock was flying after its listing, the value of Tesla's stake rose on paper, and that paper rise was booked as profit. And here is the number that should stop you cold. In its latest quarter, Tesla reported around $1.1 billion of official net income, and reportedly the large majority of that, roughly 2/3, came from a single line, the revaluation of its SpaceX shares. No cars were sold to make that money, no product shipped. A stock price went up, and that was counted as profit. Corporate finance calls this mark-to-market. Meerkat, more accurately, calls it hallucinating a profit. And before you file this under rich people problems, check whose problem it becomes. Tesla sits inside every major index, which means inside every index fund, which means inside the pension of essentially everyone you have ever met, weighted heavily, because index funds hold the biggest companies in the biggest amounts. When Tesla's reported profits turn out to be 1/3 cars and 2/3 a falling stock price, the repricing lands on all of those funds automatically. Nobody in your family chose to bet on Elon Musk's paper gains. The index chose for them. That is what it means when people say the market has become concentrated. It means other people's accounting adventures are your retirement's problem now. It is the exact logic of feeling richer because someone appraised your trading card collection while, cheekily, actively on drugs. And now run it in reverse, because that is the whole point. SpaceX stock is no longer flying, it is crashing, which means next quarter the same mechanism works backwards. The paper gain becomes a paper loss. The very thing that made Tesla look profitable this quarter will make it look worse next quarter, automatically, mechanically, with no new bad decision required. Two companies, one man, each one's headline number leaning on the other stock price, and both falling at the same time. The Jenga tower, taller and grander and hollower with every move, now missing the pieces at the bottom, and there is reported talk of merging Tesla and SpaceX, which sounds clever because if they are one entity, the paper gains do not need accounting for. But tying two sinking ships together does not make an aircraft carrier, it just ensures they hit the ocean floor together, while concentrating an extraordinary amount of risk in one structure, which is the sort of thing that makes regulators reach for their reading glasses. And think about what a merged entity would actually be. One company containing a car maker with collapsing margins, a rocket and satellite business priced for a Mars economy that does not exist, and, through the tangle of Musk's empire, exposure to an AI lab burning billions, all governed by one man's mood, all reported through accounting where the pieces revalue each other. It would be the single largest concentration of correlated risk ever assembled under one ticker, and it would be sold to the public, with a straight face, as diversification. Now, to be fair, and Meerkat is always fair even about men who name their children after passwords, none of this means SpaceX, the actual company, is failing. The rockets still fly, the satellite internet still works and reportedly makes real money. Tesla still sells millions of real cars to real people. The businesses are genuine. What is failing is the pricing, the gap between what these companies do and what the shares assumed they would become, and that gap was always the product being sold. Nobody paid $225 for a rocket company. They paid $225 for Mars, robot taxis, and Destiny, and the market is discovering that Destiny does not appear on a balance sheet, which is inconvenient, because balance sheets are what the loans are secured against. Part 3. The risk. So why is this the riskiest moment of the bubble, rather than just one man's expensive bad month? Because unlike some chip stock sliding on a China headline while nobody's uncle notices, this is the most famous company, the most famous man, and the largest listing in history, all failing on the same stage, in front of everyone, live, in a way the market cannot look away from and the dinner tables of the world cannot stop discussing. Bubbles do not pop in the boring corners, they pop where the crowd is watching. 3 reasons. First, the trillionaire mirage just burst in public, and it teaches the whole market a lesson it did not want to learn. Understand what kind of stock Tesla has always been, because it is the purest example of the species. It has never been priced like a car company. Car companies trade at modest multiples because selling cars is hard and margins are thin. Tesla has traded for years at a science fiction premium, priced not on the cars but on the story. The robot taxis coming next year, the humanoid robots coming the year after, the self-driving software perpetually one update from perfection. Story stocks are magnificent while the story is believed, because there are no numbers to disappoint anyone. The moment attention shifts from the story to the actual arithmetic, a 1.4% margin, profits made of paper gains, trucks sold to the boss's other companies, the premium has nothing to stand on. That shift in attention is what you are watching this month, live. Nobody was ever really a trillionaire. That number was measured in a volatile, illiquid stock Musk could not even sell during a lockup period. Measuring your wealth in shares you cannot sell is like measuring your fitness by how fast you could theoretically run if you ever got off the couch, a cheeky comparison Meerkat makes with love and full self-awareness. The moment the market remembers that paper wealth is not real wealth until it is sold and the tax is paid, it starts asking the same uncomfortable question about every inflated valuation in the AI trade, every private lab worth hundreds of billions on the say-so of its own last funding round, every startup priced at multiples that assume perfection, and there are a lot of them, an entire economy of scoreboard numbers that have never once been tested by an actual sale. History offers a grim guide for what happens when a market's most loved name halves. In 2000, it was not an obscure failure that broke the internet bubble's spirit, it was watching the era's darlings, the stocks everyone owned and everyone discussed at dinner, get cut in half, while the television insisted the fundamentals were sound. A crowd can absorb bad news about companies it does not care about. What it cannot absorb is the humiliation of its favorite. SpaceX was the favorite, the one stock your taxi driver mentioned, the listing people queued for, the 92-year-old's first share. Its halving is not just a loss of money. It is a loss of the feeling, and the feeling was doing more work holding up this market than any earnings report. Second, this is the moment the accounting games become visible, when Tesla, the most watched company on the market, is caught booking most of its profit from a stock price that is now falling. Investors start squinting at everyone else's books. The whole AI boom is riddled with these arrangements: circular investments booked as revenue, paper gains booked as income, suppliers funding customers, and it all works beautifully while prices rise and becomes a horror the instant they fall. Musk's own empire is a working museum of the genre. Tesla holding SpaceX shares and booking the moves. Tesla reportedly selling Cybertrucks to Musk's other companies. His AI lab leasing computing to the very competitors it is supposed to be racing. Each arrangement individually explainable, the whole arrangement collectively a hall of mirrors where every entity's health is reflected off another entity's share price, and none of the mirrors can tell you what anything is actually worth. The market spent years admiring the reflections. It has just started looking for the object. This is the first big domino where the trick reverses in daylight, and the self-dealing runs deeper than the accounting. The Cybertruck, once called Tesla's best product ever, reportedly became one of the worst vehicle launches in modern history, selling a small fraction of what was promised. And in one recent quarter, a cheeky chunk of the trucks that did sell reportedly went to Musk's own other companies, buying the product to prop up the numbers, taking money out of your right pocket, putting it in your left, and announcing record sales. When a company has to become its own best customer, the demand it was selling you was never really there. And third, the timing. This is happening while the rest of the AI market is already nervous, chip stocks falling on Chinese competition, data center debt getting expensive, the paying customers grumbling, and markets from Seoul to Tokyo wobbling on the same doubts. Nervous markets are pattern-matching machines. They do not wait for proof. They see the most famous listing in history having, and they start asking which other beloved valuations are also mostly feeling, and the honest answer, in this market, is a list too long to read aloud. A market looking for a reason to lose its nerve just watched SpaceX, the largest listing in history, have Musk get demoted from trillionaire, and Tesla's profits revealed as a stock price mirage. Risk is not a number, it is a mood. And moods, once they turn, move faster than any rocket, and considerably faster than that truck. There is one more cheeky wrinkle. Musk reportedly spent the same weeks his empire was having picking very public fights online, including with journalists asking routine questions and, memorably, a celebrity humanitarian chef, exchanges that generated days of coverage and precisely $0 of margin. A chief executive's attention is the scarcest asset a company has. The market can read where it is being spent, and lately it is being spent on arguments a man serenely confident in his balance sheet would never bother having. Meerkat mentions this only because a man serenely confident in his companies does not usually spend 4 days at war with a soup kitchen. When the primary defense mechanism is name-calling, the investment thesis may be losing structural integrity. So 3 things to watch from the couch: the launch pad from which you have safely observed every boom of your lifetime, fuel tank untouched. 1. Watch Tesla's next results because that reversing paper loss is coming, mechanically, and it will make a struggling quarter look catastrophic, and then watch how the company frames it, because the framing will tell you whether they think the audience is still buying the story or has started reading the footnotes. 2. Watch for any move to formally merge Tesla and SpaceX, because that is not a strategy, it is 2 drowning giants agreeing to share a rope, and watch how it gets sold, because the word they will use is synergy, and the word they will mean is concealment. And 3. Watch whether SpaceX's fall spreads, because if the largest listing in history dragging down its owner starts pulling the wider market's mood with it, you are no longer watching one man's problem, you are watching the pin. And keep one eye on that lockup calendar around the turn of the year, because the day the insiders can legally sell is the day you find out what the people with the most information actually believe the shares are worth, and their answer arrives not as a statement but as volume. And the ending is yours, and it is almost affectionate. Elon Musk, the first human ever valued at $1 trillion, watched half of it evaporate in 6 weeks because it was never money, only a number on a screen that a falling stock could erase overnight. You have never had a number on a screen worth erasing. Your net worth is stable precisely because it is small, illiquid only in the sense that there is nothing to liquidate, immune to mark-to-market because nobody has ever bothered to mark you at all. The richest man alive lost 3 billionaires in a month and remains, by every practical measure, unimaginably rich, which is its own lesson. The people at the top of these stories are playing with scoreboard points, while everyone downstream is playing with rent. The 92-year-old woman bought real savings, the pension funds hold real retirements. The scoreboard players will be fine in every version of this film. You, having never gained or lost anything, are the single most financially consistent person in this entire story, and in a world of hallucinated profits, your empty pockets are the only honest accounting left. Meerkat is not telling you to buy anything, sell anything, short anything, or measure your worth in anything illiquid, including potential, which your family has been marking to market for years with declining confidence. Meerkat is not a financial advisor. Meerkat is a small animal with a whiteboard, a roof waterproofing pot of tea, and a Jenga tower he has built specifically to watch fall, which makes him better prepared for this market than most fund managers. Please do not sue Meerkat. Like, subscribe, and go build something that gets sturdier as it grows. For once, a skill, a habit, a savings account with actual contents. the opposite of everything in this video, and Meerkat says this with love, the opposite of everything in your browser history.